This week, the economic calendar is jam-packed with the macroeconomic data and events, including the ECB monetary policy meeting and inflation data for May in the United States. Both events will be the key to further monetary policies for major global central banks. The ECB is widely expected to maintain its key interest rate at a record low. Nevertheless, investors will be looking for clues to the ECB plans for tapering its asset buying program. At present, the regulator purchases bonds worth €1,850 billion under the ongoing emergency program. The ECB intention to slow down a capacity of the printing press is certainly bullish for the single European currency. However, it makes sense to remind you about the latest remark by ECB President Christine Lagarde. She noted that it would be premature to bring up the issue of tapering the stimulus package. Christine Lagarde confirmed that the central bank aims to provide enough financial aid to the EU countries through the PEP package that will remain valid at least until March 2022. The same rhetoric is reiterated in the policy update. This will make a negative impact on the euro. The second event of major importance is the inflation report from the United States. Consumer prices are projected to have grown by 0.4% a month in May. As a result, the annual pace of inflation is set to speed up. Meanwhile, the US CPI has already soared to the highest levels in annual terms since September 2008, when the economy was also struck by the crisis. Market participants are alarmed that an annual inflation rate has already exceeds more than twice the 2% target level set by the Federal Reserve. The only way to temper the rampant inflation is to raise the federal funds rate. At the same time, the US monetary authorities insisted that growing consumer prices are a transitory happening, so the policymakers are unwilling to tighten monetary policy. Whatever, it could be another worrisome sign that the US economy is overheated will encourage investors to shift focus towards safe haven assets. In other words, risk aversion will trigger the US dollar's rally and a bearish trend in stock markets. It goes without saying that market sentiment is sensitive to weekly updates on unemployment claims in the United States. Analysts do not predict a sharp decrease in the number of jobless Americans and present a modest forecast. According to the consensus, 370,000 Americans filed for unemployment benefits on the week ended June 5th, 15,000 less than on the previous week. Importantly, the print in the previous report came in much stronger than expected, having declined below 400,000 for the first time since March 2020. As daily rates of new coronavirus cases are going down in the United States, the country is making efforts to revitalize business through hiring more employees in response to growing domestic demand. Besides, some states across the country decided to exit federal programs which provide jobless Americans with a generous financial aid. Experts say that a lot of Americans are unwilling to go back to work because their unemployment benefits are higher than the minimum wage. Fresh evidence of this statement is the last data on continuing unemployment claims. This figure jumped to a 10-week high. The final day of the trading week is going to be quiet. The only report worthy of attention on Friday is industrial production data in the UK for April. This is the case when they should bear in mind the low base effect. The industrial production came to a standstill in April last year, so the expected annual increase of 30.2% looks less impressive in this context. The industrial output could have eased a pace of growth to 1.3% on month from robust expansion of 1.8% in the previous months. All in all, the dynamic of the pound-dollar pair will depend on trading sentiment on the greenback. You were watching Forex Trader Calendar on InstaForex TV channel with me, Kate Tichina. We wish you profitable deals with InstaForex.